Let's see. Anyway, we will start and see if others are joining. Otherwise, they also can go through the recordings, isn't it? We'll start then.
Yes. Okay, sir. Okay.
Okay. Okay. Um, now, last time we discussed how an open market operations works in central bank. We saw open market purchase from various agents, and then today I'm going to continue that, and then we can see sale. So we stopped here, open market purchase summary. Today I'm going to continue with this open market sale. When we say purchase, central bank purchase securities from the open market. So how this balance sheet changes, that's what we saw. And then today we are going to see open market sale. So that means if a central bank wants to sell its securities, right? So what will happen to the balance sheet of a like non-bank public or like bank or central bank? Now let's say the first one, I start with Federal Reserve System, that means central bank balance sheet, right? When they sell securities, so in their asset size, they are going to lose 100 million securities, so minus 100. So to compensate that, they will get the money from, let's assume they are selling to the general public, that means non-bank public. The securities goes to the public and they will pay by cash or currency. So currency come back to Federal Reserve System, central bank. So their liability is going to be less because they already issued the currency in circulation. That's their liability. When they get that money back, so liability is going to be less. So the central bank balance sheet will be looking like this. Okay. So if you take a non-bank public, they in the asset size, they might be having currency 100 million. They will lose that currency because they are going to pay by currency and they get the securities. So here what you have to see is now money supply, right? So the major component, one of the component is currency in circulation. If the central bank wants to reduce that currency in circulation, so they can sell the securities. This is open market sale. So this transaction reduces the monitor base by the amount of the sale. If it is 100 million, so the monitor base would be reduced to or reduced by 100 million. But you could see there won't be any change in the reserve because here only change is in currency in circulation, right? So the effect of open market operation on the monetary base is much more certain than the effect on reserve, because like reserve, right, maybe there may be other reasons we don't see the changes. This is exactly the similar changes. But when it comes to currency, yes, there won't be any interference onto that. So then exactly the amount would be reduced, right? So this is open market sale. Now earlier I saw only non-bank public. Now if you take banking system also, so you can see now this general public and banking system and then Federal Reserve System.
Excuse me, sir. Going back to the previous slide.
Okay.
In that, sir, don't central bank get some money because if they sell the securities, there will be a money inflow to the central Federal Reserve System, no, sir?
Yes, that's central bank. Yes.
So currency should go up, no, sir? But here in the table, it doesn't show. I don't know. I may be wrong also.
Yeah, I think your point of view should be changed. That is very important. Very good question. Now, if you are a person, non-bank public, when you get the currency, what is that for you, asset or liability?
For us, it's a asset. If we
Asset.
get cash, of course, it's a asset.
Yes. So then your currency or cash in hand will increase. That's a plus if it is an asset. Now let's see, a currency is an asset for a normal people, but a currency is a liability for central bank.
Okay, that's why it is being adjusted under liabilities.
Liability.
Okay.
Right? So now central bank's liability is less now.
I got it. I got the point.
Yes. So this is what it works. It's a very good question. Many people confuse with that. Right? So when in other way around also you can think when the central bank issue currency, you get as assets, but for central bank that's a liability because they have to, it's kind of, they have to honor that currency, right? In any way. So it's always liability. So inflow means you are reducing your liabilities. Okay. So now, if you take shift from deposit into currency. Now earlier we just direct straightforward one, it's currency, right? Now shift from deposit into currency. Somebody is going to take first banking system because it's deposit into currency. Customer is going to withdraw, right? If customer is going to withdraw, the bank's deposit will decline. So checkable deposits minus 100 million. At same time, reserve also, because now they will pay through the reserve account, checkable deposits. So reserve also will decline, right? That's clear because like we assume this deposit goes as reserve, but when somebody withdraw, there's no deposits, then banks not necessary to keep reserves as well. So both coming down, right? So customer withdraw the money, right? So he get a cash, then the customer's point of view, the asset side, so checkable deposit will decline and he got the cash now, currency. So this is the shift from deposit into currency. When this happens, what will happen? The central bank balance sheet, now public is having currency. So central bank liability will increase by that 100 million. But same time, now there's no deposits, so reserve is going to decline as with 100 million. So central bank is going to lose the 100 million. So it's adjustment within the liabilities, right? But the net effect on the monetary liability is zero because its currency increases and reserve decreases. Whatever happens, net liability is zero. There's no change on central bank liabilities, right? Okay. So this what when the customer withdraw money, this always happen within the system. So reserve changes, so currency changes, but anyway, the monetary base would be same. The third option we can see loans to financial institution. So now currently what I am explaining is how this currency and reserves are changes in a central bank balance sheet, right? What are the factors influence them, right? Okay. And third, loan to financial institutions. Now let's assume a bank is going to get a loan from central bank, right? So we can call this as a borrow reserve as well. When somebody is borrowing from, or the bank is borrowing from central bank asset side, it goes as a loan because the central bank is lending 100 million. So central bank pass the entry to the reserve account, so bank's reserve account. So both sides, so liability is also increasing with 100 million as a reserve, and asset also increasing by 100 million as loans. What will happen to the banking system if you take a bank A? Now liability side, they borrow from the Fed, it's a central bank loan, increased by 100 million, and reserve, because it's in a central bank reserve account, so asset, that also increasing. Now we can see monetary base increase. So when you take these transactions, if a financial institution borrow from central bank, monetary base increases. But if a customer shift his deposit into currency, there's no change in the monetary base, right? When the central bank sells securities, monetary base changes. So these are the areas we have to look into, right? How a monetary base changes, right? Clear? So central bank can manipulate monetary base to achieve its price stability through these various means. So I just want to show you a multiple deposit creation in a simple model. How nothing change in the central bank monetary base, but deposits are created so many times, or the figures are increasing. How? Now let's assume the First National Bank first table. The central bank buys securities from a bank. So if you take this First National Bank as a bank, so they are going to lose their securities, the minus 100 million. What will happen? Central bank credit the reserve account. So the bank, First National Bank, will get reserve 100 million. Now within the balance sheet, the mixture of asset change. Now the single bank, that means the First National Bank, keep reserve 100 million. Now question is, now there's no requirement to have reserve. What will happen? So it's keeping in the central bank account, the bank is going to lose. So they can give money as loan to others, right? So what will happen? When they give the loan to customer, right? Listen this, when they give the loan, the customer get the loan, and then that money comes again as a deposits. Now let's assume we are talking about a single bank. Now I get a loan and then maybe pay you, then you are going to again deposit in a bank, right? We have single bank concept. So again, that money comes back to banking system. So checkable deposit, current account. So here, automatically now the First National Bank create loan 100 million as well as create deposits 100 million. Right? Okay. So if you take the First National Bank, finally, they are going to lose securities and they will have loans, right? This how the deposits are created. I have given in red line. You can see every table is explained. The first table, after the Fed has bought the 100 million in bonds from the First National Bank, the bank's funds that it has an increase in reserve of 100 million, we could see. And second, when the bank makes the loan, it set up a checking account for the borrower and puts the proceed into this account. Actually, like, okay, it can go to some other person and come back again, or like in a direct base, if I am a borrower, what banks do, they create loan account and pass that money to current account. So they create both entries, right? Here the example taken is bank create both entries, loan account, it's 100 million, and as well as current account, 100 million, the bank creates, right? So now let's assume when the borrowers make this purchase by writing checks, the check will deposit at another bank, right? Let's that check, okay, you are writing check and given to purchase some products. So that is taken to another bank for realizations. So now deposits move from these First National banks to some other banks. When they move these deposits, you don't need to have reserves. So then finally the First National Bank will be with only the securities minus and then loan. Security has been transformed into loan. Is that clear?
It's clear, sir. It's clear. So I got a question, but anyway, it is later it was explained. Ideally, when there is a loan given to a customer,
Yes.
Customer or somebody borrows from a bank, normally first entry it will be loan account debit, and if the money goes to a checkable account, it will be deposited in the account. But
Exactly. Yeah.
simply the borrower will not take money to put as a deposit. It will be used in, let's say, asset creation or construction purpose, whatever it is. But anyway, it is explained in the third table, no sir. Anyway, it
Yes.
will go back to another person and it will get credited in that person's account. That's what you
Exactly.
yeah, no, sir?
What you have to remember is whatever disbursement through, it can go to several people and finally it will come to banking system. That's understanding. You can buy real assets, you can buy any assets or services, products, but finally the last person anyway going to deposit that money into the bank system, right? So that's the concept. Now here we say third table, okay, it goes to another bank, right? Not this bank. So this bank balance sheet would be like this. Now it's clear, right? Isn't it? Yes. Now, up to now, I discussed single bank. So you see the multiple bank. Now, maybe more clarity for this example. Now, if you take this bank A, let's assume the bank A balance sheet, you have reserve 100 million and checkable deposits 100 million. That means customers deposit, you have 100 million, and equal amount you are having as reserve at central bank. Now let's assume reserve requirement is only 10%. What bank can do? They can have only $10 with the reserve account and balance 90. They can give loans because you don't normally earn interest on reserve, so you will be losing. So what banks will do? They will keep the reserve as per the requirement and balance they will lend to the customers. So then bank A's balance sheet would be like this. Okay, I have taken the loan. as we discussed in the previous example. Then I am going to pay for goods and services. So another person get that check and put it in bank B. What will happen? So bank B, the $90 will be accounted as checkable deposits, right? So they have, now it goes to a reserve account because the clearing happens through reserve account, right? All the transactions within, like between each and every banks goes through reserve account. So automatically the central bank reserve account would be increased by 90 for this bank B. Now bank B also think, okay, I can't keep this reserve as 90 because it's unnecessary. I'm going to lose. How much a bank B should have as a reserve? The bank B also required to have the reserve at 10%. So they got $90 deposits. Then the 10% of $90. So only $9. If they keep $9 as reserve, that's sufficient for them. So balance 81, they are going to disperse as loan. Right? Now, if you see the B balance sheet, now reserve is 9, loan is 81, checkable deposits is 90. Now you could see the central bank gave you only 100 million. But how many deposits are there? Now it's a bank A, 100 million deposit is there. Bank B, 90 deposit is there. So deposits are created now. This is what we call deposit creations. Within the banking system, even though the central bank issue only 100 million, the banking system create multiple of that amount. So this is deposit creations, right? So here you can see easily in this table what will happen in overall. Now you can see. Now First National Bank, okay, see the title, creation of deposits, assuming 10% reserve requirement and 100 increase in reserve. Now let's assume only 10% reserve requirement. So First National Bank give loans 100 million, right? That's the first transactions. So what will happen? Then the loan receiver, the proceed receiver, take the 100 million and use it for other purchases. Now the check will go to bank A as a deposits. Then what will happen? They can't give 100 million as a loan because there's a reserve requirement. So they will deduct 10% out of that. That means 10 million they deduct and 90 million they will give as a loan. So 90 million will be the new loan and 10 million would be the reserve. So now the bank A has disbursed 90 million. So in the customer's account, checkable deposit account, 90 million is there. So he will write the checks to supplier, 90 million. The supplier get the check and go to his bank, that's bank B, and then deposit 90 million. What will happen? Bank B deduct 10%. That means as a maintain as a reserve, and bank B disburse loan, then only 81 million. So it works like that. In the banking system, it goes through again and again and again. So it's the finally, it's only a few examples given. So again and again and again, it will happen, right? So what happened finally, if it is a 10% reserve requirement, the bank would, if you continuously calculating, you will reach to 1,000 million. So the total deposits created by 100 million loan is 1000 million, right? And increase also, deposit would be equal to loans, so it's 100 million. So now the 1000 million, right? Okay, deposit 1000, loans 1000. Your increase in reserve, that's 100 million, right? That's the initial one. So this what we say, when a central bank give 100 million, right, you will get so many deposits created by the system, loan created by the system. So why this is 1000, I just tell you, you can calculate and see, because now 10% is the reserve requirement. So normally if you put in, there are formulas, if you put the formula, so if general understanding, you could see, so it's a 10 times. So the deposit multiplier we call it, so it's a 10 times as per the initial deposits, right? So this what in a banking system, even though the central bank give a little money, the banking system creates so many deposits and induce the system to work, right? As a payment of goods and services. Okay, I hope you understand this. The problem here is, in a simple model, in this table you see, I'm assuming when you disburse 100 million, that comes to bank again. But sometime you withdraw money and keep it with you. You hold cash, then it won't. Let's assume you got 100 million, but you only deposit 95 million. 5 million you keep as a cash. So it will not go to the system. Then this creation won't happen as we discussed. So the creation will be less. So this is a problem in this simple model. And also bank, here we say bank keep only 10%. But if the bank wants to have 15% to keep as a reserve, then you don't get that. As we discussed, we don't get that money. Now let's say, now this is loan created as 90 million, reserve increased by 10 million. Now let's assume the reserve is not 10 million, the bank kept reserve 15 million, then only it can give 85 million loan. So then next bank will get only 85 million. So that happens in the market. So that's what the simple model, understanding of course okay, but you will have this kind of problem. So third, depositors' decisions, right? How much currency to hold, right? And bank's decision, amount of excess reserves to hold, also cause the money supply to change, right? Finally, so this is straightforward functionalities, but there are some critics as well. Now finally, what we can see is the factors that determine the money supply, right? So what are the activities or factors or variable change the money supply? Now up to now we discussed, you could be able to tell, so what are the factors that can change the money supply or determine the money supply? One is changes in the non-borrowed monetary base. Now through open market operations, the central bank can sell securities and get the money back, or buy securities and pump the money to the system. So money supply changes. Changes in borrowed reserve from the Fed. Banks can borrow reserve from the Fed, so then money supply changes. Changes in the required reserve ratio. Now we say 10%. So if the banks, if central bank says 15%, definitely the banks are going to have more reserves, so money supply increases. Changes in the currency holding. That's what we discussed. If public wanted to hold more currency with them, so money supply changes. And then changes in the excess reserve. Now, even though the 10% is requirement, the banks can have more than that. So excess reserve. That also, if there are changes, then the money supply changes. Right? Okay. I have given this in a summary table. You could see the three players we saw, right? Federal Reserve System, banks, and depositors. So Federal Reserve System can change the money supply through these two items. One, they can provide non-borrowed monetary base. That means through open market operation, they can fund or absorb money. When the non-borrowed monetary base increases, money supply increases. We saw that. If you see second one, when central bank increase the required reserve ratio, right? Required reserve ratio, when the variable increases, you are going to lose because less multiple deposit expansion, right? So banks borrow reserve. When the borrow reserve increases, money supply increases. But when the excess reserve increases, money supply decreases because you won't do the deposit creation. And depositors, when they hold more currency, right? So the multiple deposit expansion decreases. So money supply response decreases, right? So this what happened, right? In all 5 scenarios. If you can understand this, so you are clear, right? These are the areas you should understand in monetary policy, right? How a central bank control its money supply, right? Okay. So as I said earlier, now we know we define money as a currency plus checkable deposit. That's we call it M1 as well, right? So monetary base, that is assume currency plus checkable deposits, that would be multiplied by money multiplier to get money supply, right? So country's money supply, that is M, would be equal to monetary base, that's currency plus checkable deposit, multiplied by money multiplier. So basically you just keep in your mind, central bank issue currency and checkable deposits there, it's a monetary base. But money supply beyond that, because the banks or central bank create money, right? We call it money creations, or through which it's a deposit creation. So you have to multiply this monetary base by money multiplier, right? So that would be equal to money supply. So when we talk about money supply, in a layman word, we just say, okay, it's a currency plus checkable deposits. So for an example, we talk, but actually when it comes to money supply, it's, the available fund to make a transaction. So its multiplication is there. So we call it that money multiplier. If you have any questions, you can ask. Otherwise, we can have some practical examples. Now you could see this 2007 to 17, when the global financial crisis began in the fall of 2007, the Fed initiated lending programs and large-scale asset purchase program in an attempt to bolster the economy, right? So, as we discussed earlier, in a crisis situations, the central banks tend to increase its money supply. So then the people can, or like businesses can make more investment and activate the economic activities. So through various programs, right, central bank pump the money to the system. If you see the balance sheet of Federal Reserve, right, that increased 350% monetary base by 350%. That means large expansion, because the Federal Reserve fund more money to the system by various means, right? We have seen that. Okay, right. So we call it's a quantitative easing. Why? The lending and asset purchase program resulted in a huge expansion of monetary base, right? When you say monetary base, is the checkable deposits and currency, right? So when a central bank introduced this kind of program, right, so currency and reserve would increase, right? So then that we call, because it's a quantitative items, right? We can quantify. So we call it quantitative easing. When the monetary base expand, we call it quantitative easing. Now, if in a layman terms, if central bank printing money and supplying, so that's a quantitative easing, because the general public will get more money, as an example, right? So when this monetary base expands, it doesn't mean you will have equal change in the money supply, because we discuss that cannot happen due to various reasons, because the public can hold money, or like banks can have excess reserve. All right. So I think we discuss even central, now Sri Lankan market, the central bank made quantitative easing, thinking that, okay, banks will give more lending. But what happened? Banks maintain excess reserve in central bank. They didn't go for lending. So there's no equal change in the money supply. So excess reserve they maintain at central bank. So that can happen, right? Even 2007, even if bank sees the present situation is risky, they don't lend, right? Even like whatever the amount you release, the bank will not lend, right? So then that would be accumulated as a excess reserve, right? So central bank issue currency, then become as a excess reserve. Okay, so now you could see in this chart, starting from 2007 to 2017, this is monetary base, right? This is M1, right? You could see up to 2008, monetary base was below M1, but then increased above M1. So it's not a perfect correlation, right? You could see increasing, decreasing, because like, it's based on depositors' behavior and than bank's behavior. Right now, you are sure, like when you increase the monetary base, it doesn't mean it's going to have impact on M1. Right. So up to now, any questions? So up to now, what we have discussed is what is central bank and what is central banking and how do they manage money supply, monetary base, because their objective is to safeguard the price stability or maintain price stability. How they are doing? They are doing this price stability stable. They maintain price stable price by manipulating money supply. Right now, you know how they can manipulate money supply. So this is the central bank's function. Up to now we discussed. Any questions on that? The second part of this discussion, I'll be going through conduct of monetary policies. Now, up to now, we have seen central bank and its role. Now, I am going to specifically discuss or anybody wants to ask any question?
So, can you explain the money part by a bit more? Taking a practical example, like, sir, in one of the examples that we discussed, you said if the reserve requirement is 10%,
Okay.
the money or the deposits or the loan can be created 10 times. Like if the central bank releases 100 million at $100, it will be 1,000 loans will be created. So suppose if the rate goes up to 15 million, how does it work? Is it 1,500 or how? Sir?
No,
Can
no,
you
no,
can
no. Yes, yes, yes. Yes, here. Now this is 10%. Okay. What will happen is, without going into the detailed calculations, what could I say is, right? You take this initial amount, that's 100 million. I'm saying the calculation, right? So you are going to divide it by the percentage. That means when it's 10%, 0.1, right? If you divide this initial amount by the reserve requirement, that means 0.1, you'll get answer as 1,000, right? So let's assume the central bank increased to 15%. So you are going to now divide this initial amount by 0.15. That's a 15%. So then your deposit creations will be declined. Right? That's a calculation. But if you put that figures into this table also, you will end up with that figure. Total figure might be like that. So it's not 1,500. So this is the calculation part. To kind of intuition, if you want to think about why central bank having this reserve requirement. The central bank having this reserve requirement to control the money creation. Now, if central bank says, okay, zero requirement, so everybody we can lend 100 because I lend 100, bank A or First National Bank lend 100 here, that will go to the customer. So then bank A will get 100 deposits. Then that will give us 100 loan because no reserve requirement. So then again, that loan becomes a deposit in the bank B as 100. So it's always 100. So indefinite, infinitive ways. So then you will have more deposit creation. There's no control at all. So central bank will have a control on that, saying 10%. If central bank wants to create more money, they will reduce the reserve requirement. Now you could see in Sri Lanka during this COVID pandemic, the central bank reducing reserve requirement. Why? The central bank wants banks to create more deposits and more loan. But when you increase the reserve requirement, your deposit creations will be declining, because you can't give. If you have 100 deposits, if you want to have 15% reserve requirement, so you have to keep 15% in the reserve account, balance 85 only you can give the loan. Right? So this is the explanation. So central bank controls this deposit creations by giving a percentage on reserve requirement. So based on the market conditions, central bank changes rate. When the reserve requirement increases, your deposit creation ability will be decreasing. When the central bank reduces the reserve requirement, your deposit creation ability will increase. This is the explanation. But for calculation, you can take always the initial amount and divided by the reserve requirement. The answer would be matching with the explanation. Is it okay?
Okay, sir. I got the point.
Okay, okay. From this point onwards, I'll be giving, yes, conduct of monetary policy. I'm just more focused on the monetary policy, right? And I'll be discussing the Sri Lankan market condition. So might be more easy, and we can easily understand our monetary system as well. If I'm going to discuss the Fed Reserve, because some of them are we don't practice here. So I just directly wanted to discuss Sri Lankan scenario, right? So first of all, I just want to discuss the meaning of monetary policy and scope of monetary policy. So when we think about monetary policy, it's always an action taken to regulate or control money supply, right? Through that regulation on money supply, the central bank can control the credit. That means loan, credit creation, right? Or deposit creations or credit creations. So when you create deposit, you create loan, right? So these words, sometimes we use a credit creation, sometimes we use as deposit creation, but in theoretically, it's a deposit creations, right? Okay, so what monetary policy means, it's a program. It's a program of actions. So there are so many programs, you put it together and go for that implementation. It's done by monetary authorities. When I use central bank, it's a monetary authority. We discussed a common name for central bank is the monetary authority, right? So to control and regulate the money supply, a program of actions undertaken by monetary authorities to control and regulate money supply. Money supply with whom? With the public. And flow of credit, okay, the bank's credit or lending, right, with a view to achieving predetermined macroeconomic goals. So predetermined macroeconomic goals, there may be so many goals, but I'm here always talking about price stability. So basically, in overall, the central bank will think, to maintain this price stability, what should I do? Increase money supply or decrease money supply? This is the work of central bank. So nothing much, like it's a very complex system anyway, but in a layman terms, central bank look at the price level, inflation, and see to, okay, this is the price level, this is the inflation, what should I do to change this price level? Increase money supply or decrease money supply? This is monetary policy. So I just set a flow for you. The Central Bank of Sri Lanka always assess the market price level, and it will think, okay, whether this price level is high or low. So then if that is high or low, based on that, it will decide what would be the changes in money supply. So every month, right, there are monetary policy meeting, researchers, everything is there. So they will decide what to do. So this is the conduct of monetary policy. As I discussed, the scope of monetary policy, right, may be different among various monetary authorities, country to country, but in a basic terms, it's a entire area of economic transactions and macroeconomic variables that monetary authority can influence, right? Entire area. If a monetary authority can control maybe inflation, maybe exchange rate, maybe employment, anything. So if central bank, so anything that can be controlled by central bank, monetary authority, that's the scope, right? But that depends on, first, the monetization of the economy, usage of money. If you use money, more money for transactions, yes, it's a different economy. Or some economies, they use less money. And second, the level of capital market development. So if highly developed capital market, these big banks and financial institutions, they do transaction through capital market. They don't come to, general public and do the transactions, right? So scope is entire transaction, economic transactions, but it can be, the size can be based on the monetization of the economy or capital market development. So basically, you have to understand the central bank's point of view, whether to increase or decrease the money supply. So, but that sometime you may not be able to use the same tools because every country is different. I hope you have some idea now. Okay, so next, we are going to see monetary policy instruments and target variables. Now let's assume, okay, Central Bank of Sri Lanka, they are going to conduct monetary policy. They need some instrument for that. And they should have some variable, target variable to achieve as well. Two things. You should have instruments and you should have target variables. Right? So the central bank can choose any variable at its discretion, right? Central bank can choose any variable, right? To control supply of or demand for money, right? Money supply or money demand. They can choose any variable to control, right? And then availability of credit. So these are the two areas central bank will play around. One is supply of and demand for money. Second, availability of credit. We have seen how that supply of and demand for money works, right? And availability of credit works towards price level, right? So when it comes to instruments, there are two kinds of instruments central bank can use. One we call it quantitative measures, other one we call it qualitative measures or selective credit controls, right? Let's see next what are the quantitative measures and what are the qualitative measures a central bank can use to control money supply and credit growth, right? Let's see first one. The quantitative measures, we used to say conventional measures or traditional measures or several names. These are the normal measures a central bank, usual measures a central bank can take to control money supply or credit growth. So one is open market operation, we have discussed. Second, bank rate or discount rate. We call it here in Sri Lanka bank rate, but we have seen in our Federal Reserve System, we call it discount rate, right? And third, cash reserve ratio or statutory reserve ratio. So SR reserve. We were talking about 10% reserve. Yeah, that can be called cash reserve ratio or statutory reserve ratio. In Sri Lanka, we call it SRR, statutory reserve ratio. Right now, what is open market operations? Can anybody say me what is open market operation? Now we have discussed anyway. I just want to see whether in a simple term you understood that. Any idea what is open market operation? Just say there can be right or wrong answers.
Sale of treasury bills and bonds.
Yes. Central bank can sell or buy government securities, right? Through that, what is going to happen? Now, if a central bank, okay, central bank, as I said, always assess the market liquidity, right? Okay, if central bank think, okay, market liquidity is not sufficient, we have to pump more money, right? So banks are not lending, or banks are not lending in between them. There's a shortage. So central bank will pump money. How? Buy back government securities, bills or bonds. So they will buy the securities. So securities come, this is what we discussed earlier. Securities will come into central bank's hand and central bank increase the reserve, right? So pump money into circulation.
Excuse me, sir. Is this called repo and reverse repo?
Yes, actually, now there's no repo, reverse repo term we use. Yes, this is what we call those days repo window or reverse repo window, right? Now we don't call it. Okay, is that okay?
Okay, sir.
Yes. So central bank will do these transactions, right? So buy back securities, so pump money, or if they want to reduce the money in circulation, they can sell government securities and get their money back, or reduce the money in circulation. So central banks always, most of the time, play around with this open market operation to manage or control or regulate the money supply. Right? Let's assume I give an example. Now central bank think, okay, its inflation is increasing. Now central bank wants to reduce the inflation. So then what central bank should do? Central bank will offer government securities for sale through banks, right? So government central bank is going to sell government securities. So what people will do, they buy them through check. So they give the check and get the securities. So what will happen? Money transfer from buyer's account to central bank. So now the buyer's account to reserve account, right? This will go to central bank again. It's a now central bank account, right? Because they return the money and buying securities. So what will happen? Reduce total deposit, decline credit creation capacity of the banks. Now what happened? The public money has gone to central bank. So there's no more deposits now. If there's no more deposits, they cannot give loans. If they cannot give loans, then again deposit creations also decline. Now central bank can reduce the flow of bank credit to public, then decline money supply or credit control. And if the credit is controlled, then inflation can be controlled. This is the step-by-step movement to reduce the inflation. If you simply, without going through this each and every steps, if you simply think about starting point A to that end point, the central bank sells government securities, then public money goes to central bank. Now you don't have money to demand goods and services. So then goods and services prices will not increase. Then inflation will not go up. So in a simple, very simple context, that is the ultimate effect. But if you go through step by step what will happen to each and every stages, this is the way we have to look into. Is that clear?
It's clear, sir. I have a small question.
Yes, sure.
Earlier, I think during first 2-3 lectures of this financial system, we learned that government issues treasury bills and treasury bonds to meet their expenses. So, is it the same way they do to reduce inflation, or is it another mechanism that we discuss here?
Two things. One is, this is the intention is to reduce the inflation here. But your point is government funding you are talking about now. Oh, if I understand.
Yes, government funding only, but it is we discussed that every Monday or Tuesday, I think every specific day, government issues auctions, treasury bills,
Yes,
and the money will be taken from the primary dealers, and there will be secondary market. With those things we discuss. So, is it the same way central bank issues government securities through banks
definitely.
to reduce inflation?
This is the same way. Same way. Window is same. There's no change in the window. The purpose is different. This is to reduce the inflation. But if the government needs a funding, that also will be going in the same way. What will happen is central bank issue the government securities to the market and get the money, and they put in the government account, not the central bank account. So then there won't be any change in the money supply. You got my point. Because like
Yes.
now government account also maintained with the central bank. So it's a reserve account. So then that will go to government and government will again spend. It's additional money. Now if you see, okay, forget it about the market. Now government wants the money. What will happen? Government sell the security to central bank. Central bank buy that security and give the money to the government. So new money goes out under reserve account. So if that is the case, then money supply will increase. Government get the money. the central bank will not use this window, because the central bank will use this window when they want to get the money back to central bank or pump the money to the market. But the mechanism is similar. If an other way also you have to think, okay, central bank is not going to give the money. Let's assume the banks and primary dealers are going to give the money to government, then it's two leg. One, the central bank issue government securities as we discussed in the previous classes and get the money from the primary dealers or banks and give the money to government. You got it what I'm saying?
Yes, sir. I think the purpose is different.
Purpose is,
Earlier, yes. So
you are right.
yes, if the central bank wants to reduce the inflation without the intervention of the government, they issue the securities and get the public money into their reserve account.
Exactly.
And if they want to finance the government or government requirements, they issue securities and give it back to the government. So
Yeah.
there won't be any impact on inflation by doing that.
No. In the sense, you have to consider two ways of doing that. Now, government needs some money, give the securities to central. It's a government securities. Give the securities to central bank, and get the money means it's new money coming from the central bank. So then you will have more money supply. That's one way of doing. Or if central bank not giving new money to the government, the central bank sell that government securities to the market and get the money from the market and give it to government. You don't change the money supply. Because the money is already there in the market. So just changing hands from banks to government, from public to government. There's no new money coming in. But if that is not happening, the central bank directly dealing with the government. So central bank should give, new money to the government. So that's what, let's assume money printing. Now, as an example, if government wants money, they give the securities to central bank print the money and give it to government. This is the increase in money supply. But you have to think here, government also similar to banks and general public, because it's the money going out from central bank to all these three people. If the money goes from central bank to government, it's new money, changes in the money supply. But if the money goes from a bank to government or general public to government, so nothing change in the money supply. It's in between already in the market. It's in between them. You got the point?
Yes. How do we determine this is for reduce the inflation and this is for government expenditure? How do we differentiate when government central bank issues treasury bills or treasury bonds or government securities?
Yeah. Now, the banks, the money market or bankers will get to know those information. Now, government is in deficit, right? They are in deficit. So definitely the banks or the participants will know, okay, we are going to fund the government, right? Central bank is going to fund it, right? Or like banks, these treasury bills and treasury bonds are issued to get the funding to the government, right? Or if there's no deficit, no request from the government, right? It's purely the market can get to know, okay, this is to play around with the money supply. There's no kind of direct indication, okay, this is for this or this is for this, right? So two separate things. But market can read easily Okay, whether it goes to government. Now let's assume now government payments are okay. There's a request or government payments are coming, or government is short of money, right? So definitely the market read that. The information is available. But central bank is not going to announce like this is for government and this is for like manipulate the inflation. No,
So
that's right.
yes, I got the point. And sorry to interrupt. I think I'm asking so
That's
many
fine.
questions. So this to meet the government expenditure, central bank issues securities, it will not impact the inflation, right, sir? It will, the money will go one hand to another. Is it correct, no? Am I correct?
Uh, if you put it together in the sense, whose money going into government? Is it a central bank money go to the government, or banks or general public money goes to the government?
It's
That's,
general money, public's money.
yes. So then there won't be any change on inflation or money supply because it's already counted in money supply, right? But central bank is going to give new money to government, then only the problem comes. Inflation and increase in money supply. You got it?
In that case, it will be money printing, right?
Yes, money printing. Sometimes it's in a normal sense we call it money printing, but it doesn't mean necessarily there should be a money printing. It's a just entry, right? Central bank will have entry, right? Just pass the entry in between central bank account and treasury account. You got my point?
Yes, sir.
If
Thank you. Thank you.
now sometimes I don't go into so much of details. Now sometimes here also we have reserve account, right? So in between bank and central bank, right? So what will happen is, if a central bank going to give money to bank, it doesn't mean central bank print the money and give it to bank. The central bank will say, okay, let's assume loan account debit, and let's assume commercial bank reserve account credit. That's it. So money supply so money supply increases because now you have more reserve. Just an entry, you can increase the money supply. Now if central bank is going to give loan to government, in the central bank balance sheet, loan account debit and government reserve account credit. That's it, just entry. So money supply increases because reserve increases. So in a normal terms, we talk about money printing. That's what, like, counter arguments are coming. It's too technical. So sometimes even the market people who are raising the question, they don't understand. So the people will explain this is not a money printing. We didn't print any money. Something like that. Stories will go around. Finally we have to see whether money supply increase or not the money printing exactly. Right? Money printing is one of the item within that. Clear?
It's clear, sir. Thank
Okay.
you.
No worries. So now it's other way around. If central bank wants to reduce inflation, so we discussed already. So central bank will offer government securities for sale. Banks buy them. So that means banks get the securities, and then banks transfer their money to central bank. When they transfer money to central bank, their reserve account would be deducted. Then if the reserve account reduce, then they cannot do credit creations because they have no reserve. So that means no deposits. So they don't do the credit creation or deposit creations, right? So then there will be a decline in the credit to public. So bank cannot do more credit, so lending, so then they cannot do loans, right? So if they cannot do loans, so supply of credit will be less, so then it controls inflation. People will not get sufficient money, so they cannot demand goods and services, more demand on goods and services, so then price won't increase. So basically, the central bank controls the credit creation. Through that, they can control the price. In a pandemic situation, you could see the central bank pump more money because like central bank wanted to have everybody to have some money, excess money, so then they can buy goods and services. If you all are like very active, I can say again, I can remind you again, I think we discussed in a crisis situation or like pandemic like this, economic activities will be dropping continuously, right? Factories might be shut down, right? So offices are closed and workers are not coming to work. So we have to restart these activities. We have to increase the GDP. We have to produce more. As we discussed earlier, I think in the first class, the central bank, forget about central bank. If you want to increase the product or production, you have to give more capital or more labor to increase the production. Let's assume it's a factory. You should have more machineries to increase the production. You should have more laborers to work in the factory to increase the production. But it cannot be done overnight. It will take, because you need the capital, you need the labor force, increased labor force. So it takes so long. It's a population growth. It will take so long to improve those. So the supply side, we call it supply side, you cannot do one in a short term. But demand side, if you give more money to the public, they demand more goods and services. When they demand more goods and services, factory will put overtime and bring the employees and produce more. So in a short term, only way you can increase the production is through increasing the demand. That's what in a pandemic or crisis situations, the central bank try to pump more money, then people will have more money and demand more goods and services, so production will increase. The problem is when the people have more money but production is not increasing, what will happen? Anybody?
Prices will go up. Prices will go up. No, sir?
Exactly. So there will be a inflation. Now in Sri Lanka, inflation is increasing. People have more money, but there's no goods and services supply increases. Then what will happen? Only the same quantity of goods and services available, but you have more money. So yes.
But sir, please correct me if I'm wrong.
No
So
problem.
when there is a pandemic, I read somewhere, not only Sri Lanka, other countries like Japan, some other countries, they also have printed money just to increase the money supply,
Yes.
and it will definitely lead to what do you call that, increase in demand, and ultimately there will be some economic activities.
Yes.
But when it comes to pandemic, not only, let's say, people will always try to get only the essential goods like foods and other stuff. But since the offices are closed and people are not going to work, uh, non-essential items like, let's say, shoes or office equipment, demand for those goods will definitely go down. No, sir? So,
Yes, go ahead.
so at the same time, but even if the government tries to increase the money supply, it will not give the demand that was earlier. That's what I put. That's my point. So I want to know whether it is correct or not.
No, you are right. Perfectly right. Uh, you in a pandemic situation, you try with several instruments, right? This is one of the instruments we use to, in a conventional instrument, we use to promote economic activities. It doesn't mean it is sufficient, and it doesn't mean it will work perfectly. Some other countries, of course, infrastructures there, okay, it can work. But for our country now, we have to be very clear. We can't compare US with Sri Lanka. Now, in Sri Lanka, when we print money or increase the money, so okay, similar, we will use printing money. When we print money, that can be used only to buy goods and services within Sri Lanka. If you want to buy foreign inputs, maybe factory inputs, right? Or intermediary goods or final goods, you need the dollar. Then you are stuck there. Even though you have more money in your hand, you can't import anything. But if you take US, if you have, because that's a reserve currency, if you have more money, you can buy locally within the country as well as you can buy from abroad as well. You will import all intermediary goods and your production would kick off, right? Compared to Sri Lanka. So country to country that differs. As I said, it doesn't guarantee like all of a sudden, like when you pump the money, the economic activities would start immediately or as expected. But when at least for this consumer goods, or like if you take garment productions, right? So they don't have, okay, they don't have enough demand. Let's assume demand from anybody. So they have to maintain their factory for some time, right? Some time. So at least if we pump the money, even not only buyers of general public, even the businesses, they can use, they will get the easy credit from the bank at a lower cost and they will manage their working capital. So it gives you a kind of time lag to survive, not only increasing production. So survival also very important. So nowadays, so many moratoriums are coming. Why? Because until we kick off or back to normal, these businesses should be surviving. So one hand, you are giving more money. Other hand, you are giving a lot of moratoriums and a lot of waive-offs, right? So it's so many, and other times you are moral situation, you are controlling interest rates, right? You bring down the interest rate for 4% working capital, give this, because we want them to survive during this pandemic situation. So you put it together and see, how can this economic activities little improved. Is that okay?
So basically, when there is a pandemic, both demand side and supply side both are reduced, right? Not that only the demand, even the supply will go down.
Yes. Yeah, true. um,
Okay,
okay.
sir, I got it. So I just
Yes,
wanted to
supply
make
also
sure
will
that.
go down. Yeah. Only thing is how we can, induce them. That's the question, right? One of the short term. That's what I always tell you all. Keep in mind in economics the short term measures and long term measures. That's very important. Long-term measures, forget about pandemic, long-term measures, you have to increase your capital, you have to increase your machineries, buildings, infrastructure, that is, and increase your labor. We always think capital plus labor, that is the input. You cannot overnight do that. So it's a long-term aspect. So supply side, you cannot do. So demand side, in a short-term period. So when it comes to this kind of crisis, it's a short-term, not a long-term phenomena. So you can only stimulate this through this kind of monetary policy, one kind, this kind of short-term measures, right? As you correctly said, the pandemic is different anyway. It's a global phenomena. In a crisis situation, if it is only for Sri Lanka, of course, that's a different scenario. It's pandemic all over the world. So pandemic supply side also, when you say supply side, okay, we are importing from Japan. They also give, stimulus packages to increase their production, right? So everybody will give. So just to push the economy a little bit up and keep it for a while and then relax it. So all over the world it's happening. That's what, like, at least some extent it's performing. Even you could see in 2007 financial crisis, every country, including US, they gave like helicopter money I discussed, right, to increase the demand. Even Japan, it's the 0% interest, right? They hit the bottom, right? So now they are back to normal before pandemic. Now again the problem, right? After 10 years, and then again we will be back to normal. But these are the mechanism to push out. Only thing is you cannot isolate a one instrument and see the impact. It's a overall mixture of instruments. I think you already got it, but I just want to give some hints on that as well. Okay, and then sometimes open market operations and also reduce the demand for credit as the actual rate of interest goes up, right? This also we have to see in another angle. When they do the open market operations, the interest rate at which the security is sold is very important, right? That interest rate can trigger the bank. Hello, can you hear me?
Yes, you can hear.
Okay. So then that interest rate can translate into market, right? So then market interest rate can fluctuate. So sometimes market interest rate can go up, or sometimes market interest rate can come down, right? So then that can have impact on the credit that we should understand. I have given the example. If you are going to sell a 100 face value bond at a 90 rupees, if central bank sell it at 90 rupees, so then 10%, right? 10% cut, right? So then now the interest rate will be like, you are going to invest on 90 rupees and get 10 rupees, or let's assume income, right? So your rate of return is 11.11, right? Sometimes, so it's based on this price. So if the price induce the rate to increase, sometimes if they can sell it at 80 rupees, then definitely this rate will go up, right? 20 divided by 80, 20%. So based on this rate, even all these market rates, lending rates will be changing. So sometimes even though the central bank buy or sell bonds, sometimes that rate behave differently to curtail the objectives. So the central bank will, that's what always during this OMO, right? There should be a indicative rates. Central bank normally kind of indication will be there. Okay, this is the expected rate. So when the bank's primary dealers quote a rate, they will quote around that rate. Now, the previous question, you could remember like this case, bonds case. Now, market read that okay, government need funding this time, so the central bank is going to sell more securities. So we can quote more rate because government need funding. So that information, if somebody get those information, right? So market behave, in a strange manner, right? So it's a market participants read sometimes, right? So what I want to say is, so this rate can trigger changes in the market rates, so that will in turn affect the credit creation. So two ways. One, you are pumping the money or absorbing money. Second, through this OMOs, you set the rate as well. I hope you got some idea on that.
Sir, are we experiencing the same thing right now in Sri Lanka? Because recently the treasury bill prices or the interest rates are moving upward trend. So, are we experiencing the same thing here right now in Sri Lanka?
What do you mean by experiencing same thing?
So, you said this by increasing the interest rate, it will lead to decrease in demand for money. So right now we are also seeing an glimpse of sorry, increase in trend of interest rate. So is
Yes.
it the same or something else?
Uh, it would be similar in the sense, now if I start from the interest rate increases, okay, treasury bill increases. Now your question is whether this market interest rate follow that. That's what your question.
Same
Oh,
thing we discussed right now in the next slide. I think the same thing, no, sir? The same thing, the rate of the treasury bills, and it impacts the money demand.
yes, yes. Yeah, there will be a same thing definitely, but only thing is there will be some lagging periods, right? So now we call it the monetary policy transmission, right? So you trigger today, central bank make the changes response to the crisis today, but that reach the market or end user after some time. We call it lag period. So definitely that will be going towards like that, but it can be maybe another 2 quarter, maybe another third quarter. So normally what we have seen is in the market is the responses will reach the ultimate target group within 3 quarters. It will take at least 2 to 3 quarters. So for answer your questions, yes, now treasury bills are increasing, right? Others cannot do immediate repricing. It can be loan or it can be deposits. Nobody can do immediate repricing. So in our market, it will take another 2 or 3 quarter, maybe a 2 quarter to respond to that rate. Clear?
It's clear, sir.
Okay. Now this is, as you said, this is the perfect period. This pandemic is the perfect period. Anybody can practically understand what is monetary policy, because central bank all over the world, they used all the instruments to stimulate the economy. Only thing is the impact cannot be separated and seen. This is because of this is because of this, because it's all put it together in a single basket. It's working like that. But you could easily see what a central bank can do in a crisis situation. So many things. I think it's out of the box, beyond books sometimes. So everything is tried, not only Sri Lanka, but also all of the countries. Now there's a new theory called modern monetary theory. Just for understanding, it says the central bank can print any amount of money and give it to the agents, and economy can be stimulated. But as I explained earlier, that can be true in US because that is their reserve currency. They can print any amount of money. It works successfully some extent. That's what I read, or our discussion shows with the various parties. But whether it can be successful every country, that's a question. Because like US currency is a reserve currency that has the value even if that currency goes out of US. But question is other countries. Say as example Sri Lanka. If our money goes out of country, and can we buy anything? That's a question, right? So think about now, if you go through the central bank press releases, okay, within last 2 years, so many, I think there's a summary document what central bank has done during this pandemic period. So it's a very nice document, but it's a very precise manner they have stated. If we can go through and understand the reasonings, everybody knows what is central banking about. Okay, I think yes, this one. Now central bank decided to increase money supply. If it's a straightforward one, we discuss. If a central bank wants to increase money supply, it can buy back government securities through banks. So people sell them. Money transfer from central bank account to people accounts in the banks. Increase total deposits, as we discussed. So people get the money and put in the deposits. So when they have that money in the deposit, the bank can create more credits, right? So more deposits and then more credits. So the bank credit goes to public. So it's increased supply of credit. If other things given, so that means other thing constant. This is always we used it. Flow of money from banks to public increases. So then what will happen? Money supply increases. So always when I discuss each and every example, other things given, that means it's constant. Other factors constant. So if you bring other variables into this, maybe different outcome. Up to now, so I think we have seen a practical point of view how OMO works, right? And how central bank can manipulate money supply or control inflation. Is that okay?
Yes, it's clear.
All right. Okay. I also given this what we slightly discussed earlier. Sometimes this open market operation may be ineffective, right? So now let's assume the first point, central bank wants to pump money to the market to create, credits, and then money supply, so people can demand more. But if the market, the money market, let's assume banks, if they have excess liquidity, even if central bank give more money to the banks, it will not happen because bank is not going to lend because they have already excess liquidity. So giving money through OMO, it's not going to work. That's ineffective. We have to find out other solution. That's what we say. we stop this on OMO operations, and we call CEOs. We call it moral suasion. We have like monthly meeting with CEOs, bank CEOs, and say them, lend. Or if you're not lending, tell us the reason. Or we say to the general public, if banks are not lending, send us your complaint. We will look into them. So if this is not happening, so central bank will look into other avenues. Right? So introduce some easy credit scheme, the Saubhagya and all other schemes. Or maybe working capital scheme with a less interest rate. So central bank will look into other avenues, right? This is one. So when the market is highly liquid, no point of giving more money to the market. And period of depression. Sometimes maybe in this pandemic as well, even though you push the credit, now banks, so when we say, okay, give the credit, but banks response, no, we are ready to give. Nobody is coming, right, to get the loan from us. We always wanted to give loans, but businesses are not coming to us to get the loan. So period of depression, because nobody is solid about the future, then they don't go into ventures. So then it's lack of demand for credit also. You cannot do anything through OMO. And then third, when banking system and capital market are underdeveloped. Now Sri Lankan banking system is highly developed, some extent, but capital market is not that much developed compared to international capital markets. Because like just to say an example, I said when the central bank take action, it will take at least 2 to 3 quarters to reach the ultimate target. But in a highly developed banking system or highly developed capital market, it will go within few months. The transmission happen within 3 months. There won't be any, red tapes in between. So then your ultimate target would be reached within a shorter period. So in a highly competitive developed banking system, right, it may go like that. And number 4, popularity of government securities is not sufficient. Now, if US Federal Reserve is going to issue government securities, all over the world, people are going to invest. But if some countries like central bank, not central bank, Sri Lankan government securities, if you are going to issue, we have to promote hardly, push hardly, right? Then only like few people will buy from local or outside, especially outside. So popularity also very important. So sometimes open market operation would be ineffective due to these reasons. Now let's assume central bank go for auction, but only less people are bidding. What will happen? You cannot pull out the money. This kind of experience are there, right? Okay, so sometimes the OMO may be ineffective. Up to now, OMO done. Is that clear?
It's clear, sir. It's clear.
Okay, good. So second, under quantitative measures, the second item, we mentioned bank rate or discount rate. What is mean by bank rate? If a commercial bank wants to get fund from central bank, at which the central bank is going to charge, that's the rate, right? So maybe different rates. Even pandemic, the central bank reduced this rate and encourage banks to borrow from central bank, right? If a central bank wants to reduce the credit creation capacity. What will happen to the rate? Can you guess? If central bank wants to reduce the credit creation, that means central bank doesn't want to lend to the banks. So then central bank, central bank will increase the bank rate. I have given the example, right? So when central bank increase the rate, what would be the effect when central bank increase the bank rate? You keep in mind the bank rate means at which the central bank is going to lend to commercial bank. That's a rate. So if central bank increase the bank rate, the effect would be, first, reduce the net worth of government bonds, because now market rate increase. When the interest rate increases, then the the securities mark to market value will go down. So reduce the net worth of the government bond. So when the government bond net worth reduced, that reduced the commercial bank capacity to borrow from central bank, because they have to give, if they want to borrow from central bank, they have to give securities. That is acceptable securities are the government securities. Now earlier, they can give 100 rupees worth of treasury bills and can borrow 100 rupee. But now when the bank rate increases, government securities market value will go down. Now they can borrow little compared to earlier. So if they can borrow only little, so they will have only little reserve, right? So then when they have little reserve, they cannot create credit as usual. So credit creation capacity will go down. So finally, the flow of credit would be reduced. So even through the rates, whether the banks lend or not, through the rates, this can happen, the bank rate. So that's what now, when the central bank increase the bank rate, the government bonds net worth will go up, the bank can borrow more, their reserve will increase, then what will happen? They can create credit, more credit they can create. This is the effect one, right? I hope, sorry. What will happen? The effect two, the commercial bank also increase the discount rate. Now, when the central bank increase the rate, the commercial bank follow it. They will increase the rate because now their cost is high. So then the cost of credit will go up. That means lending rate will go up. When the lending rate goes up, discourage the firms to discount their bill of exchange. So they don't come and borrow from you by discounting their bill of exchange, right? So then the demand for fund is decreases. So I have given a condition that demand for credit is interest elastic. Normally demand for credit is interest elastic. That means when the interest rate goes up, demand of credit will come down. Interest rates comes down, demand of credit will go up. It's an interest elastic credit. I'm not talking about here inelastic relationship. So when that is the case, so demand for fund is decreases. So even effect two also, through this mechanism also, the demand for fund or credit is decreases, right? So what will happen to the deposits? The bank lending rate is quickly adjusted to deposit rate. So that means deposit rate will increase. So people will serve more, so increase serving, and the money flow into bank as deposits. So public, so money with public decreases. So that is deposits mobilization effect. So these three ways the bank rate can work through, right? So central bank can adjust bank rate to achieve these three things. So central bank can easily, right, cut the credit or expand the credit capacity, credit creation capacity, and then deposit mobilization as well. Now in this pandemic situation, central bank reduce the bank rate, so push more credit, right? And same time people, they don't want to keep deposits because it's very low rate translated to deposit rate. So now people are pulling money and spending, so that also will create more demand. Now when the interest rate increases, now it's the current scenario's interest rate increases not because of bank rate, right, but it will be reversed. Is that okay?
Yeah, here's a in the effect 2, what do you mean by bill of exchange in this effect 2?
And normally it's bill of exchange. It's a common name we are using here, right? So let's assume as an practical example. Now you are going to you get the kind of payment, right? Now import bill or export bill, something like that. Okay, export bill. You are going to discount at the bank and get the money, right? So then they will do the discount and give you, but now at a higher rate. Discount rate might be higher. Or like bill of exchange is a common gentle name. Even let's assume like, okay, when it comes to firms, even kind of agreement, right? So you cannot, or like commercial paper. Let's assume commercial paper. You are a firm, right? You are going to give the commercial paper and get the money. So it's a face value 100 rupees. But now earlier this bank gave you the 90 rupees, but now the bank give you only 80 rupees at a discount, right? Further discount. So discourage firms to discount their bill of exchange. They don't come for borrowing, right? They don't get it. This is a kind of legal terminology. Any, so for borrowing, if you are going to give this kind of bills, so then that's coming under even check, right? Bill of exchange. Now you see, an exporter, right, or exporter, like within like locally, or producer, he sold the goods and get the check, that's a bill of exchange, and go to the bank, and he wants to get the money discounting that check, right? So in the sense, check means like, it doesn't mean like, okay, you go and give the check and immediately get the face value, like, okay, it's a 6-month dated check, so you're going to discount, right? I'm just explaining with some example. So they will discount, right? They don't give the full value, they will discount and give you. So the discounting amount will be higher. So bill of exchange is the common name we are using here. Is it clear?
It's clear, sir.
Okay.
Sorry to disturb you again and again, sir. One more
No
thing
problem.
I have.
Yeah.
So in the effect 1, hello?
Yes. Yes, go ahead.
We know that the interest, if the interest rate goes up, the value or the price of the securities goes down. So that we earlier in early sessions we learned that.
Yes.
So in the effect 1, it says the reduce the net worth of common fund. Is it the same thing?
Same thing.
And when we get money by central bank, so they will be giving money based on the market price. That's
Exactly.
why it happens. No? That's
Exactly.
why we're getting a lesser amount.
Definitely. Yes. In central bank, there are like Monetary Law Act, Banking Act. The Monetary Law Act clearly say how, in what circumstances, a central bank can lend to a commercial bank, and what are the securities the commercial bank should give, and at what value, whether it's face value or market value. How do you value that? Everything is given, and if it is not there in details, there's a Banking Act supplement to that. So, and the direction supplement to Banking Act. So it's a procedure is already developed. So then through that only it's controlled. So as you said correctly, it's a market value. Is that okay?
Yes, sir. Thank you very much.
No worries. And then the third one, traditional measures, we usually again and again we discussed, right? So SRR, statutory reserve requirement, right? This is the reserve account, right? So what does that mean? A percentage of total deposits which commercial banks are required to maintain in the form of cash reserve with central bank, right? This statutory reserve requirement, it's applicable to commercial banks, right? So they have to have a percentage of their total deposit with the account in central bank. So through this SRR, we can, central bank can play around. So that's what we have shown in the table. When they increase the rate, okay, lending will go down, right? When they reduce the rate, so can lend more, right? In a pandemic crisis situation, so several times central bank reduce this SRR bank rate. You can see in the central bank website, right? So if they want this, these terms are very important sometimes. If they want to control the money supply, that means we call it contractionary monetary policy or tightening of monetary policy. If central bank governor talked about monetary policy, he might be saying, okay, our stand to our monetary policy is contractionary, or we are going to have tightening monetary policy. That means you are going to control money supply. So you can do it through SRR, statutory reserve requirement. So you can increase SRR. So other hand, if you want to have expansionary monetary policy, that means you are going to expand the money supply. Or easing or relaxing monetary policy. If you go through the press releases, so it would say like that, expansionary monetary policy, easing monetary policy. So that means you are going to expand the money supply. So that means you are going to reduce as SRR here, right? So through statutory reserve requirement, you can manipulate the money supply as well. Okay. Now, if you want this calculation, earlier we discussed, right? I have given examples here, right? Commercial bank total deposit is 100. SRR is statutory reserve requirement is 20. So then if you go through this, right? So now loanable fund, this is the total initial deposits. Now how much loanable fund? They can only loan 80 rupees, right? Out of 100, because 20 rupees going as a SRR. So then we also could see deposit multiplier, that is 1 divided by SRR is a 5 times, right? Okay, so then how many deposits or how much deposits can be created? So the initial loan here is 80, right? From that only you are going to create deposits. So 5 times 80, 400. And then the initial deposit is 100, so 500. Even though the initial deposit is 100, now you have 500, right? So now 2 ways you can calculate. You can calculate the 80 based on 80 and at 100. Otherwise, you can straightforward, as I said earlier, right? 1 divided by 20%, right? 1 divided by SRR. So into initial deposits, that's a 500. So your deposits creations, right, or 400, right, with the initial deposit. So altogether your loan is 500. So this what through SRR you can create deposits and credit. So it's a straightforward one, nothing to worry. You can just work out and see by changing the SRR rates. I think I have given here a 20 to 25% what will happen, right? So bank credit will be 400 this time. So when you increase the SRR by 5%, you are going to reduce the total credit by 100. So central bank will, change the rates and control the credit creation capacity. And also very important item here I have given, the SRR is also used as a liquid management tool in bank to prevent financial crisis. Because what do you mean by SRR? It's just statutory reserve requirements. The banks are going to have this reserve at central bank. In a liquidity issue, central bank will give the concession to these banks. Okay, you can get the money from your reserve account and manage your liquidity. So in a crisis situation or any financial like kind of pandemic situation, you may be able to use those reserves as well. So SRR, two front or two usages are there. One, it can control the credit creation or deposit creation capacity. On the other hand, it can be used as a liquidity management tool. Is that okay?
Okay, sir.
Okay. So up to now, we have seen quantitative measures. One is open market operations. Other one is bank rate or discount rate. Third one is SRR. These are quantitative measures. And as I said, sometime or more may be ineffective, right? So you cannot every time change this bank rate, because when you change the bank rate, all these net worths are changes. So then you cannot have that kind of market. And then you cannot have every time changes the SRR as well. Then in a short-term measure maybe, or based on the central bank idea, they can use qualitative measures also, or selective credit control. Now say an example. If you want to increase the credit growth will go to all the sectors. But central bank wants to have only consumer sectors. So they wanted to go, create credits only for consumers, personal consumers. So they can relax these credit card loans. Right? That's what I say, selective credit control. So that kind of thing, the central bank can use qualitative measures. So this qualitative measures, right, may be effective or sometimes may not be effective. It's based on the market conditions. So here you can see 4 types of qualitative measures. One is credit rationing. Second, change in the lending margin. Third, moral suasion. D, direct control. Right? These are the qualitative measures. Now, credit rationing, I'll tell you one example. Even though you push credit creation through various means, always there's a complaint. Agriculture sector is not given sufficient credit because it's always high risky area. So what central bank did? Central bank said, okay, all the banks should maintain their portfolio minimum of 10% to agriculture sector. It's a credit rationing. So every bank should lend 10% of their total portfolio to agriculture sector. there's no quantitative measurement, right? Like earlier as we discussed, it's a qualitative thing. Second, change in lending margin, right? Say an example. Now we wanted to have more vehicle. Then central bank will say, okay, your LTV value, loan to value ratio can be from 50 to 70%. So then banks will lend more. If it is a 1 million worth of vehicle, up to now they were lending only 500,000. Now we have increased the LTV value from 50 to 70%. Now so they can lend 700. Or if you say 100%, they can lend full. So people can buy vehicle. So this is a change in lending margin. Or like securities. So we are saying, okay, shares, you have to have a haircut of 25%. So that means you can lend only 75% of the share value. But central bank can say, okay, if it is a S&P shares, you can go up to 90%. Then share market would, perform better sometime. And the companies can get more money for their investment. So it's a selective credit controls. And then C, moral suasion. As I said, whatever the ways you do, but if the bank management is not taking care of that, so it's not going to be successful. So we send the signal to all these CEOs. Okay, take a note of this. You have to do this, right? It's a moral suasion. So everybody should have their, inherent character to, achieve those overall objectives. So every day, like it would be monitored, or like a message would be passed or communicated to CEOs, top level managements. It's like that. And D, direct controls, right? So when it comes to direct controls, okay, so put a cap on, right? So directly, in the sense, go to the specific item, right? It's not the market, it's maybe particular bank, to go to a direct item and handle the matter and request them to have, okay, this is what we wanted. So it's a direct control. So in a qualitative measures, we can have this 4 items. Actually, I have given this explanation. Credit rationing is there, change in lending margin is there, and moral suasion and direct controls, right? So as I said, we will send a direction.
Hello.
Yes. Go ahead.
Can you explain this moral suasion and direct control? What is the difference? Almost explain. So,
sorry, I didn't get your point.
the difference between moral suasion and direct control.
Yes. Direct control is something is forcefully we are going to do, right? We say, okay, the central bank will send a direction, right? You have to do it. This is what we have to do it. So if they cannot violate that, it's a direct control. But moral suasion, we call them and ask them, it's a little bit more kind manner, right? It's just a letter. Okay, we suggest you to do this one. Or in a CEO's meeting, please lend more. Please look after this customer point of view. Please reduce your interest. So it's kind of, what do you call, kind of democratic way of handling the matters. But direct controls, it's a clear directives. You send a direction in writing, maybe a letter, send it to CEO or board of directors, right? So they have to do it. So these are two different, slightly different things. Moral suasion, it's kind of an amicable solution. or direct control, central bank will use its authority. Clear?
Yes, sir.
Okay. Okay. Now we discuss. Okay, in a quantitative method, we discuss open market operation, bank rate, SRR, and then that will translate into we call it transmission. That will translate into the end ultimate agent in the economy. So the process, how that works, it little bit differs from two theories. I just want to plug that also here, because like the economist can discuss in different ways. I just want to have here to shake off argument. You also should know there's a transmission mechanism of monetary policy that sometimes differs based on these two theories, right? So first one, we call it Keynesian process, right? So Keynesian process, what they say is, when you increase money supply, that increase in cash balances. So if let's think about the central bank increase the money supply, you get more cash. Now what to do with that cash? You can invest on treasury bill. Now excess cash you have, right? So that means you demand more financial assets. When you demand more financial assets, so interest rate decline, because so many people wanted to invest, so then interest rate will decline. When interest rate decline, right, so now the investors can borrow easily, so they will increase the investment, other hand, right? And then when they increase the investment, the overall aggregate demand will increase. I think the first lecture we discussed the three approaches for GDP calculation. One is Y is equal to C plus I plus, what else? Anybody can say? G plus X minus M. So where I means investment, right? So when the investment increases, aggregate demand will increase, right? Okay. So Keynes says, when your cash balance increases, you will increase the demand on financial assets. That's what he says. So because of that, interest rate will fall, right? But there's other theory. It says, we call it monetary process. That theory says, okay, you increase money supply, increase cash balance, but when you get the cash balance, you are not going to buy financial assets, you are going to buy real assets, maybe machineries, land and building, real assets. So it's automatically, when you buy that, so it automatically increase the aggregate demand. If you want to buy a building, so then aggregate demand will increase, because when you buy a building, so all material and all demanded, right? Okay. So the two different thing is, ultimately you are going to anyway increase the aggregate demand, but now the process is two different process. One is you increase financial assets demand and fall in interest rate, but other one is straightly you go for real assets, right? Okay, so it's countries to country. No, normally these theories are basically based on from empirical researchers. That means based on the past data they arrive. So it may be country to country different. Some countries may be Keynesian process might have in place, but some countries the evidences for in support to monetary process, right? So, but you should know, okay, there can be two different transmission processes. And also, if you want to understand further, there's a theory ISLM curve. If you can read about that, you will get some idea, because the ISLM curve put it the financial markets and goods and services market together and explain the interrelationship between these two markets is explained, and then it arrives at market conditions. So then, just if you have time, just try to read. It's up to you all. Okay, this is monetary policy, right? Transmission. Next.
Excuse me, sir.
Yeah.
Sorry to interrupt you again.
No, that's okay.
As per the Keynesian process, increase in demand for final assets leads to fall in interest rate. How does it happen under Keynesian process?
Yeah. It's you have the money, right? You are going to buy financial assets. Example, treasury bill. Right now, like everybody is demanding treasury bill. Now let's assume it's a normal demand supply curve. Now government knows everybody wants to have treasury bills, so demand is high, supply is low. Then what will happen? The government can sell treasury bill easily at a lower rate, so automatically in the market the interest rate will come down. You got my point? You put
Yes,
it?
sir. I got
Yeah.
it, sir. I got it. Thank you.
Okay. You can just think about a demand and supply curve. If you move down the demand curve, okay, increase the demand curve, right? So supply is no change, right? When you increase the demand, your interest rate will decline. Just draw and see it. Okay. Next one, the limitations, right? The limitations and effectiveness of monetary policy depends on the following factors. Now, this is also very important to understand, because like central banks can have different ideas and changes in the monetary policy, and take various measures, but sometimes you don't get expected results. It doesn't mean central bank is not central bank is doing bad, but it means there may be some of the limitations for them as well, right? One, as I explained, time lag, right? Second, problem in forecasting. Third, non-banking financial intermediaries, and underdeveloped money and capital market. I just touched upon earlier as well. The time lag, even you today increase the interest rate, it will take more time to reach the ultimate agent, that may be general public, right? So there will be a 3/4 gone. So then the people will perceive that, okay, central bank is not doing good, but there is the limitation already there. And second, problems in forecasting. You have to forecast everything. That's what central bank, it has on economic research department. Their work is to study the economic system continuously and then forecast, right? Proactively take the measures by forecasting future trends. But forecasting is always with error, right? So if you can't forecast very closely, then your monetary policy may be ineffective. Now let's assume, okay, central bank printing more money, thinking, okay, there won't be any inflationary pressure in the future due to these various reasons, but your forecast may be wrong. Then you will have more inflation. And then see non-banking financial intermediaries. Now this monetary policy can pass through banking system. Bank rate, yes, through banking system. SRR through banking system. But now let's see the most of the people are using non-banking financial intermediaries, that means finance companies or whoever it is, any other informal channels, then it is not going to work that much effectively. Even you reduce the interest rate, people will go to the village, the whoever like informal lender, and borrow at a higher price, higher rate. What is going to happen? So you don't get expected outcome. Similarly, underdeveloped money and capital market. So then you don't clearly pass on to those impact. I have given here the time lag, right? Explain clearly, and then the time lag may be two time lags. One is inside lag, we call it preparatory lag. That means you do the research, find out a problem, and then find out the solution. But during that time, you lose time. When it comes to implementation, now see the problem might have changed, right? So it's an inside lag. So outside lag, okay, you implement the measures, but to see the impact, it will goes another 2-3 quarters, right? So then it's a outside lag or response lag. So a time lag is one of the problem. So then problem in forecasting and non-bank financial intermediaries, and then underdeveloped money and capital market. I just want to say, up to now we were talking about monetary policy framework, and I was telling always the objective is to control inflation. So more like countries, they will set an inflation rate 2%, 3%. If you take New Zealand, okay, 2%, and maybe a little bit tolerance, right? So something like that, they set the inflation and then do all these monetary policy activities to achieve that. But we call it inflation targeting. In Sri Lanka also, we were telling about mid-single digit. That means around 5 to 6%, that area. But we didn't fix any rate. But that is called inflation targeting. So monetary policy framework can be inflation targeting, or some countries that can be exchange rate targeting. Some countries fix peg, right? Fix it to USD. Okay, 1 USD is 200 rupees. You fix it. You never let it go away or changes. You do the monetary policy according to that. Or some countries can have multiple indicator targeting. Or they will say, okay, interest rate should be this level, exchange rate should be this level, or monetary aggregates or money supply should be this level. So they fix it together. It's multiple indicator targeting. Or some people target nominal income. So this country's nominal income should be like this. So they do the monetary policy based on that target. Or some central banks target monetary targeting. Okay, money supply. This should be the monetary aggregate. So Central Bank of Sri Lanka, even though it says, okay, they are expecting mid-single digit, but still in formal way, they are following monetary targeting. That means how much money supply should be in the market, right? So what you have to understand from here is the monetary policy framework can be inflation targeting, exchange rate targeting, multiple indicator targeting, or nominal income targeting, or monetary targeting. So these are different frameworks. Every country can adopt in their own, whatever their preference, based on their preferences. But Sri Lanka, we are adopting monetary targeting. If there's any question, please ask. Okay, so here I just want to elaborate something in Sri Lankan context as well. That's very important. So if you see the history from 1980s onwards, Sri Lanka is following monetary targeting, right? When I say monetary targeting, just understand we are talking about the money supply. How much money should be in the market in a layman language, right? Okay. So as we discussed earlier, now you see this framework, right? So as I said, in a final objective, that's a central bank objective. What is that? Price and economic stability. To achieve this price and economic stability, central bank fixed, it is the ultimate target, right? Final objective. So central bank fixed intermediate target, right? That is monetary aggregate, broad money supply. So what should be the broad money supply to achieve the final objective of price stability? Clear? So then money supply is the intermediary target. To achieve this intermediary target, the central bank will have an operating target. That is the interest rate. Average weighted Coleman rate. That means what should be the rate to achieve this broad money supply? What should be the rate at the money market? So money market, where the banks borrow and lend, right? So that's a call money rate. So what should be the call money rate? So the central bank knows if the call money rate is 5%, so then monetary aggregate like this. So if we can maintain monetary aggregate like this, so inflation might be like this. All kind of forecasting, right? Okay. So then to achieve this operating target, the central bank can have policy instruments we discussed. One is open market operations, reserve requirements, bank rate, moral suasions, or even policy rates, right? So we call it policy rate and open market operation policy rate, like I'll let you know what's happening currently. So these are the overall conducting of monetary policy, right? This is the way central bank work towards. Right here I have given a little bit more explanation. Price stability is to be achieved by influencing changes in the broad money supply, right, which is linked to reserve money through a multiplier, right? So the broad money supply is linked to a reserve money. We discuss always this reserve with the money multiplier, right? So reserve money is the operating target of monetary policy, right? Now the monetary targeting framework is operated through a monetary program, right? So we can call it this is monetary program as well. When we give the definition, you can recall it's a program of activities. We said what is meant by monetary policy. It's a program of activities to control and regulate money supply. So this is the program of activities, right? So this what central bank, this how central bank do it. If you have any question, you can ask, right? Here only questions or like doubts you can think of is, what is monetary aggregate? We just simply discuss money supply or monetary aggregates or like monetary base interchangeably up to now, because I don't want to go into that detail. But now you can think about what is monetary aggregate. So monetary aggregate, you give you put different monetary items together and give a name. It's a monetary aggregate. Why we are doing so? Because the market or economic system is different among the countries, all around the countries. So then every country needs different combination. Some country talked about reserve money. Some country talk about narrow money. Some country talk about broad money. Right? So every countries have different idea about this idea, in the sense different usages in their monetary policy. Some country can use narrow money, but some country can use broad money, right? So whatever the names, it's a combination of monetary items. I will let you know. So it's a common name given is monetary aggregate, right? So here you can see it's a central bank, a Sri Lankan definition for each and every item. So definition of monetary aggregate, it can be M1, M2, M2B, M4. These are the key ones used here, right? So what is meant by M1? The M1 is currency held by public and demand deposit held by the public. That's what we discuss, checkable deposits always. So this is, we call it M1, right? So we sometimes use M0 also. M0 means currency held by the public, right? M0 and M1, these two. M2, M1 plus time and saving deposits held by the public. That's DBU, domestic banking unit, always we talk about. And M2B with M2 plus time serving deposit held by the public with FCBU. It's all public, right? And then M4 means M2B plus time and serving deposits held by the public in licensed specialized bank and time and savings deposits held by the public in finance companies. So this is the aggregate. We call it maybe M0, M1, M2, M2B, M4. When it comes to Sri Lanka, right, we usually concentrating on M1 or M2B. We are using everything, but for sake of different objectives, right, we go with different monetary aggregates. So M2B is most of the time we used for analysis, right? So different countries can take different aggregate, right? This is a generally accepted way, but here these are the four we mainly used, right? So here in this ladder, when it comes to monetary aggregate, right, we tend to take broad money supply, right? So broad money supply, broad money, you can see what is that? M2 and M2B. Linked to reserve money through money multipliers. So this M2 and M2B is this. So this is our, you can see, intermediate target. Is that clear?
Yes, yes, sir.
Okay. Here, like in Sri Lankan situations, I have discussed already, but just a sake of having a Sri Lankan comparison, I put it here as well. So in Sri Lankan Central Bank, what we are using is key instruments of monetary policy. One is OMO and SRR and bank rate, ceiling of interest rate, of course, even the pawning, pawning loans, credit cards, we have ceiling, right? So those are there, and moral suasion also. We have like several times, so continuously we are using. So these are the key instruments of monetary policy used in Sri Lanka. And I have little bit elaborated on OMO in Sri Lankan perspective, right? You can read and understand now, right? One thing I have to say here, policy interest rate, right? We have policy interest rate, we call it standard deposit facility rate, SDFR, and standard lending facility rate, SLFR, right? Now, if a bank wants to have deposits with central bank, so the rate will be given like this, SDFR. As I discussed earlier, you could remember, this replaces the repurchase rate of central bank, which was in effect until 2 January 2014, right? Earlier we call it a repo rate, reverse repo rate. Now it has been changed. That's what I said earlier. So now we call it standard deposit facility rate and standard lending facility rate, right? So deposit facility, that's a lower limit the central bank pay, and the SLFR is the upper limit the central bank charge on banks borrowing. So this is the rate we set it. So any rates will go through in between. We call it interest rate corridor, right? I think there should be something. No, not here. But you can. You might have heard a name called interest rate corridor. So this interest rate, market interest rate, the money market interest rate will go through in between. Why? Now let's assume a bank has excess money. They have two options. They can go in park in other bank, or deposit in other bank, or deposit in central bank, right? Then if central bank giving 5%, if other bank give 4%, what will happen? The bank will come and deposit at central bank. So definitely other banks are not going to set below the central bank rate. So the other banks, they are going to set their deposit rate above the central bank deposit rate. So it's, if it is the central bank deposit rate is 5%, maybe 6%. Similarly, the lending rate, the central bank set, then the other bank should set the lending rate below that. Then only the banks will go and borrow from other banks. Otherwise, they can come and borrow from central bank. So lending rate also will be within this limit. So this is the lending rate will be the upper limit. Deposit rate will be the lower limit. So money market rate, the lending and deposit rate should be within that corridor. It's automatically, practically that would work, right? So these are the two rates you have to keep in mind, right?
So excuse me, sir.
Yeah.
Earlier we discussed the discount rate given by the central bank. Is it the same here? The SDFR and SLFR?
Yes. Is that okay?
Okay, sir. I got it.
Yeah.
Hello, sir.
Now.
Hello.
Okay, so now this process also we already discussed, but in a central bank perspective, you could see the two instances. One is where there is excess liquidity in the market, so central bank want to absorb, then they will sell the securities to the market and absorb the excess liquidity from the banking system. So it's a second instances. So if there's a liquidity shortage in the market, central bank buy government securities from the market and inject liquidity to the market, right? So this is the process, right, in a OMO, right, in a simple term. So Sri Lanka also following the same thing, right? Now, I think I explained this interest rate corridor. You could see it's in the rates in between SDFR and SLFR, right? I have explained to you why the central bank fixed this. Central bank doesn't want to have too much of fluctuation, right? So if they said normally you could see only 1% difference. If it's SDFR is 4.5, SLFR might be 5.5. So the bank's interbank rates would be set in between. So central bank always have the control, right, on this money market rates, right? And also you should, in practical sense, Central Bank of Sri Lanka, at least once a month, they evaluate and see whether is there any adjustment required. So this also kind of monetary policy evaluation, right? And based on this adjustment, they can, control the reserve money target and growth in money supply. Okay. Okay. So here we have given statutory reserve requirement. I think the present after it was 5%. Now it should be 2%, I think. And bank rate also, it has been declined or reduced to 8.5%, right? You should understand the difference between this bank rate and this one, right? Bank rate in a crisis situations, you are going to borrow from the central bank at a rate of 8.5%, right? But this one, in a liquidity shortage period, you are going to borrow. Or if you have excess liquidity, you are going to park, right? These two are different. Sometimes there's people mixed up with this one, right? This 8.5 bank rate, and then this SDFR and SLFR. These are two different things, right? This SDFR, SLFR, to give a corridor, the central bank, right, can shift this corridor up or down, right? So based on the market liquidity assessment. But here, this is for like a basic rate. If any banks having an issue in a crisis, that time they should be able to borrow. It's actually lender of last resort, right? You might be heard, I think we discussed lender of last resort. The central makes the last one, yeah, the look after a crisis bank, right? So at the end, central bank, one of the initiatives, central bank can lend at 8.5%, right? And also the difference is when you are in a crisis situations, you won't be having any securities. At that time, like there are approved securities they can give and borrow. But here, like normally, you have to give. Yes, go ahead.
Hello, can you hear me?
Yes.
So, in order to control the interest rates of the market, the central bank used the standard lending rates, no? Not the bank rate.
Yeah. Yes, you are right. Perfectly. So the bank rate is totally different, right? In the sense, but there are like in between you can think of as well. No, bank rate, when the bank rate is higher, right? You don't come and borrow. It's even though like I say, two things. If we go into details, okay, first of all, I'll take this one, SDFR and SLFR. This is the key rate, right? If you have excess money, you can have deposits. if you have shortage, liquidity shortage in the market, right? You can borrow from central bank at this rate, right? So the central bank, if raise this rate, then automatically the money market rate also will go up, right? If central bank reduce this rate, money market also will go down, right? Through this rate, the central bank can manage the liquidity, right? Okay, so market that means like money market liquidity can be managed, because like if there's a shortage, the bank can come and borrow, lend from this window, right? But here bank rate, in a crisis situations, the bank can come and borrow, right? But only thing is, this also can go up and down. That will have an impact, right, on the rates, because like if somebody is going to borrow at higher rate, they will set their rate also higher. The market will automatically go into that rate, right? Now let's assume if you are going to give your security to borrow at this rate, right? So your rate is, the borrowing rate is plucked by this 8.5%, then that will be translated into your rate, right? So most of the time, this influence is very low, bank rate. Normally, even other, in practical sense, the banks are not coming to borrow until this rate, because like if somebody is coming to central bank to borrow, then central bank will like perfectly get to know this bank's in trouble. That's what they are coming to this window. So it's rarely banks coming to borrow at this window. If they want, normally they borrow through this one. I answer your question, or?
Okay.
Yes, just think about if there's a further clarification, I can explain. This is the standard window, right? But this is in a crisis situation. Here, the rate SDFR and SLFR for all the banks, if they want to make a deposits or if they want to make a loan, that's for them. Let's see next one. I just want to give some kind of what's happening in central bank. We have the central bank's apex body. We call it monetary board. You say like in a bank, it's a board of directors, but in central bank, we call it monetary board, right? Monetary board, there will be a governor and secretary of the treasury and other 3 officers appointed by excellency, right? So if you go from bottom to top, you have in central bank a department called economic research department. Their job is to take all the data, collect all the data, all variables, and analyze, do the research, and always update their findings to Monetary Policy Committee. We call it MPC, right? So when they go to this MPC, before that, they will have a consultation with MPCC. We call it Monetary Policy Consultative Committee. So central bank will, you would have seen recently the governor of central bank appointed eminent professional from the market to that. These are external parties. So there will be a MPCC. You can get the advice from them as well, because they are coming from the private sector. They will say, oh, this is the reality of the private sector or market reality. So this ERD, Economic Research Department, take into their advice also and give the recommendation to Monetary Policy Committee, MPC. So the Monetary Policy Committee will review their findings and then give the recommendation to governor. Right? Governor will go through and see the recommendation, right? And then submit the monetary board or take the decisions at the monetary board. Right? So this is the process we follow. Is that okay, or any other practical questions about central bank? Okay, so then you could see here, right?
So small thing, this banking supervision department and non-bank supervision department fits in where in this hierarchy?
Yeah, here, yeah, that's a good question. Normally, when we, as a financial expert, we like when it comes to central bank, we think about is the bank to the bank. Then they work with the banks. So that is the key duty of a central bank. Actually, the key duty of the central bank is price stability. But Central Bank of Sri Lanka co-objective with price stability and financial stability, system stability. Here, I didn't bring those departments here because here I'm talking about the price stability and conducting monetary policy and how that happens within the central bank. We have discussed that one leg, that means price stability cluster. We call it price stability cluster. This is one leg. Other leg is a financial system stability cluster. They have their similar committees, similar departments, as you said, bank supervision department, non-bank supervision department, right? And others supporting departments, they get together. They do their research. And macroprudential department, there's a department called macroprudential department. So macroprudential department job is similar to this ER department, but they belongs to financial cluster. This ER belongs to price stability cluster. So these people will be doing research and submitting recommendation on price stability. The other leg towards financial system stability. So bottom of that, you can see bank supervision department, non-bank supervision department, and macroprudential department. So then they will give the recommendation to financial system stability committee. There's a consultative committee. So they will give the recommendation to governor. Then that will go to monetary board. I didn't take that into account here because the scope of this discussion is price stability. That means conducting monetary policy. Is that okay?
Okay, sir. Got it.
Yeah. Actually, your syllabus covers this area, and then maybe we would discuss even financial institution under that. But anyway, like with this syllabus coverage, that is limited to that, right? Okay. So final, you might see this. The Central Bank of Sri Lanka, they have the schedule, right? They have the schedule, monetary policy press release schedule, or they will have a discussions, and then After discussion, they will think whether they are going to change any rates, right? So they will have all this research analysis, and after taking into all the considerations, they will say what they could do, right? Whether they are going to change policy rates or SRR, right? Now, this is the scheduled meeting. So, monetary policy review number 8 of November 2021. This is the latest one. So, they will give the title in a summary, right? So, the Central Bank of Sri Lanka maintains policy interest rate at their current level. So, it's market, financial institution, public, everybody immediately will get, flash it. There's no change. Then they will explain the rationale. One is kind of introductory para, and then the Sri Lanka economy is gradually recovering, the observation, and then it's a local economy. Then we also talk about external sector remains resilient against strong headwinds. So you can see the explanations there. Then we talk about the market interest rate have increased or what's happened within the market. And then explanation on inflation. So it says inflation accelerated recently mainly due to supply side disturbances. So supply side disturbances means not the demand side, supply side, right? You could see the explanation. And then they will conclude that policy rates are maintained at current level. So after every meeting, there will be a press release. The meeting may be sometimes 8 or 9 or 10. So the Central Bank Monetary Board will decide how many meetings we are going to have it, right? So finally, these are the policy decisions, monetary policy decisions. So this is the latest press release. So policy rate and SRR unchanged. Now I think the slides I didn't change that. So this is the latest one. SDFR at 5% and SLFR at 6%. And bank rate, it has gone to 9% and SRR 4%. Now you could see one question. What is the changes you observe? This is more than the previous one or less than the previous one? Anybody? Now, okay. Now this is increased. Say, check with the previous slides. This is increased. Now take an example. I will take one. This SRR. Early it was 2%. I think early in the sense like a couple of months back, right? 2%. Now it's 4%. What is mean by that? Now central bank want to control. This is now contractionary monetary policy, right? Kind of tightening monetary policy because they don't want to create more lending, right? They don't want to ease the market, quantitative easing. So now they are raising the interest rate, right? Because they want to curtail the inflation, right? Inflation is increasing. So now they wanted to reduce inflation. So they don't want, they want to control the credit creations, right? They want to control the money supply. So now rates are going up, right? So see with one or two previous press releases and compare and see what's the trend going on. Okay, so this is what central bank does with regards to price stability. I think we have covered the monetary policy as well. So next class, the final one, Sunday. Yeah, go ahead.
Just to clarify certain thing. Sir,
Yeah.
hello.
Yes.
The impact on the changes made on this deposit, standard deposit facility rate and standard lending rate facility rate.
Sorry, I couldn't hear you. Yeah.
Can you hear me now?
Yes.
Just wanted to clarify the interrelationship between the bank lending rate for customers and the standard. I mean, these two rates, the standard deposit facility rate and standard lending facility rate. How that impact on the customer rates, the rates offered by the banks for customers, like what is how it what is the connection between that, say, uh, when the central bank wanted to reduce the bank lending rate on customers, how they adjust this? Can you just
Yes, definitely. Now, in a simple term, now you increase, right, deposit rate and lending rate. Now, let's assume you are going to borrow from central bank, right? So definitely your cost of borrowing going to increase. Now, if you take the money market, where the banks lend each other and borrow, right? That's what I always explain. So it will first affect the money market, right? So when the interest rate increases here, okay, central bank increase the lending rate, definitely money market rate will go up, right? When the money market rate goes up, then the cost of fund of the banks goes up. So when the cost of fund of the banks goes up, they will increase their lending rate, right? So it will take some time, but that's what lag time. So after some time, normally this lending rate increase, banks are immediately, in the sense like within a short period they increase. When as and when the agreement renewal comes, they immediately increase. But the transmission of the deposit rate to, the deposit rate of the customers, it will take some time, because bankers, they don't want to increase immediately. They just delay as much as possible and increase. So it will go like that based on the cost of funding. So when they lift up this one, so that triggers the money market rates, right? Because I said the money market rates always within this corridor, right? So within this corridor. So definitely when the corridor shift up, then money market rate will go up. When the money market rate will go up, then definitely the bank cost of fund will go up, and that will pass on to customer, right? You also can think, okay, if no bank is going to borrow from money market, but okay, even though you are not borrowing, there's an opportunity created for you, right? You will income more profit. Then definitely you don't miss that chance, right? You increase your lending rate. So this is the signal central bank giving, right? The every rate will be going to increase. So definitely that will pass on to the customer. It will take some time, but definitely the lending rate is like moving faster than deposit rate. You got the point?
just to clarify, sir,
Yes.
say, if the bank has funds, they can get 5% from the central bank, according to this. Is it correct? I
If
mean,
bank wants the fund.
I know if the bank have excess funds and
Yes,
they go and deposit at central bank, they give 5%. Is it correct?
they give 5%. But if they can lend it to some other banks, so they will give 5.5%.
Right, right. All right. That means if the central bank increases this deposit rate, accordingly the lending rate of banks will go up, right?
Exactly. You can uh, I didn't have the picture. You can draw a few lines and you can see, okay, so when it's a corridor, you just shift. You cannot, the rationale behind that is you cannot go beyond these rates, because that is loss for the banks. they'll be within this range because they can do whatever transaction with central bank rather than going to money market, right? There's no incentive them to go to money market if the rates of the money markets are different. That should be always within this corridor. I answered your question, or you have still some gray area?
Okay, sir.
Just go through, and if you have any doubts, even next class we can discuss. Next class would be the last one tomorrow, Sunday, 1:30, and where we will look at the foreign exchange side as well, international finance, and then we can look into 1 or 2 questions, something like that, and we can finish it off. If you have any doubts, you can raise in the last class tomorrow afternoon, 1:30. Okay, then thank you so much.
Thank you, sir.
Thank you, sir.